That's my perspective. No, there. Or here. Okay, so sometime so basically the agenda is like this. Today we'll be talking about the key thing for startup or any business for that matter, what that is. And another topic I would like to cover is, since we are in the startup world and like everyone is talking about VC money and raising money, and there are like so many discussions about it, whether you should do it or not should do it, and whether it's good or bad. So I would like to discuss that a bit. And then the last part would be like the actual meat of the finance section, like what is important for startups for finance perspective, what are the like general basic things you should understand. And then tomorrow we would be spending on building an actual budget, an actual business case, which you can then later use either to understand how much money you need, what is the timeline, how the money allocation is spent over time, how soon you need to launch your business in order not to run out of money, what's the sort of minimum amount you need to sell in order to break even, etc., etc. These kinds of things. So yes, so my question to you is, what do you think a startup should focus on? What's the most important thing?
Profit.
Providing value.
Bring the value, as I mentioned.
Bring a value. Yes, many. In a sense, all these questions are correct. Maybe you can, my dear assistant. Yes, yes. But the thing is, in reality, building is not the most difficult part, but selling is. And unfortunately, it is a problem even for startups who has been in the market for 10 years. They are still struggling with sales, and that is like the top thing where your attention as a founder or owner really should go. Right now, I have a client, a startup which has been operating for 10 years. And they are still struggling. They are still struggling to get the sales up. They have reached their threshold. They are barely making even, and all the founder really is thinking about is how to actually improve the sales, how to get the company growing, and all the other things really, the product, everything else. That's just a proxy. It's your instrument how you earn the money. But for you as startup founder, you should switch your mindset really to mindset of a business person. And then it doesn't matter really that much whether you are selling bananas in the central market or building startup, because the mentality is pretty much the same. What you really should focus on, like how you can deliver the value to your customers and get money for that. That's the key challenge, really. Not so much about what features the product should have, and so on, because that's the issue I see sometimes with startups, that startups sometimes are founded by people who like doing a particular thing. They like, let's say, building something, building a product. They like the product itself, but they don't like the business side of the things. But you really should understand that what makes it successful really is 70 or 80% is the business side, and product is really just a small part of that. Yes. So next slide, please. Yeah. So recently, last week, there was news article that in Deutsche Bank, the highest paid employee makes twice as much as CEO. And can you guess like what this person is doing? Sales, exactly. He's bringing in the money for the bank. So that's also typically what I see working with bigger companies, that salespeople are making a lot of money. And that's the key function of any organization, really, of any business. Focus on sales, on making money. Okay. Yeah, so the general thing about like how you should look at the business is that people or companies buy stuff because it solves some problem or it's there. For example, Coca-Cola or soft drinks or anything, technically it's not a it's not a necessity, but it's everywhere. So like people buy this product because it's so widely available. Unfortunately, you probably cannot really fit in this category because that takes huge amount of money. So you cannot be there. So you have to be very good at solving some problem. So next slide. Um, yeah, and the problem which I have seen is that where startups fail is that the value delivered is too small. So basically, you identify something, you think that okay, it would solve a problem for someone, but then it turns out that the problem maybe is not real or is not that important. And obviously, when you go to someone and say, hey, would you want to buy my product? It will solve this and this problem for you. And the problem is not that important. Like, why should I spend my money to buy your thing? It's if it's not like bringing me any real value. So that's one thing. Then market is very small. Small markets per se is not maybe a problem, but sometimes the problem is that the market is too small. For example, you are going in a niche of a niche, like sub niche of a niche, and then it gets very complicated because again you need to do the sales, and in order to do like I would say sales is really a numbers game, a statistics game. I will show you an example. So basically, statistically, if you want to, depending of course on industry and the business model, if you want to make one sale, you need to have like five I don't know, leads, 5 discussions with potential buyers. And then in order to have these 5 discussions, you need to like 100 clicks on your website. If you want 100 clicks on your website, you need to run like certain amount of Google Ads or whatever. So pretty much that's a numbers game. And if I don't know where should I stand so everyone can see that. So basically, the problem is if these, and this is called like your sales funnel. The problem is if the top part of this funnel is very small, then you mathematically there is not sufficient number of potential clients to whom to speak in order to reach one sale. If you have not 100, but you have just 20 here, statistically, you would not be able to get conversion to actual sale. And that is a real problem. And that is sort of, that's how things work. And there are mathematics and statistics, unfortunately, behind the sales process. And everyone who has been working on sales or who has been running digital marketing, they know this very well, that there is this sales or marketing funnel, and you need to have sufficient number of like target audience to whom you can speak to in order to arrive to actual sales. Yes. So when you actually launch your product and when you start selling, I think one of the biggest problems for you would be that you would arrive at the problem of hard sell, and you would go to this group of customers and you would find out, okay, I have very difficult time selling to them because of this and that and that and that, and for all those segments you would find some problems why you cannot sell to them. And that's not fantasy. That's what I see, like working with actual companies and especially starting out, and they start targeting one group and they say, okay, we cannot sell to them because of this and that and that and that, and there are other groups and they also cannot sell to those. So your job as a founder is to talk to as many, identify as many potential buyer groups as possible and find out for which group you provide the most value, figure out what your value proposition is, and then figure out how to sell to them. For example, if you are selling software to accounting companies, for example, there would be different segments of these accounting companies, and there could be like individual accountants, there could be accountants working in big companies doing accounting work, there could be small accounting firms, and there could be like big accounting companies. And then you should approach all those different segments and find out for which of these segments your product makes the most sense and what is the value proposition which has the most value to those clients, which are the marketing channels, how you can approach them, and what is the sales process. Can you please? Yes, so pretty much like that's how it works in real life, and this is sort of cheat sheet for you when you actually go to market, how you should run the process. Basically, you should figure out these segments, and basically the thing here is that when you build a product in the beginning, you have probably some idea what is the use case. But the use case, you need to validate that use case. And what you need to do is actually to go to the real clients. And by the way, one very good thing to do is, actually, I was working with Riga Tech Girls, and there was one team, and they were also sort of not sure like what the use case is, what is our the group to which segment to which we should sell. And basically, I said to them, there are a few guys, some potential companies which could use your product, but go to them and don't try to sell, but go and ask for advice. Like go and ask what do you think we should improve in our product, etc., etc. So I introduced them to those people in those companies. They went, and actually after a few meetings, one of those guys in those companies, he pointed exactly out the exact value proposition. So what they did, they actually changed the product because they found out that, okay, here is the real use case for a product, and here are a bunch of different companies. Like they found out there's a big market actually for their product. So this process in the very beginning is pretty much about discovery. You go out, you start with some idea, you go out to the potential market, and then you test whether there is an interest in what you are selling, whether the value proposition clicks with your clients. And then you need to test whether this what are the acquisition channel. For example, if you are talking to big accounting firms, probably you need to do the reach out through LinkedIn. You need to talk to them directly. You somehow have to get the physical meeting, etc., etc. And then for this group, you need to measure, okay, what was my cost to sell? And then after that, you can figure out like this is sort of back and forth game, how you can figure out like whether your price makes sense. So for example, you sell some accounting software for I don't know, for 99 euros per month, and then you find out that in order to get this one sale, you need to spend a certain amount of, I don't know, you run let's say 1,000 euros on LinkedIn campaign. You reach those people, you make the sales calls, whatever, and you sell, and you get like 5 contracts out of those. So you know that basically cost per acquisition is 200. 1,000 divided by 5, 200. So obviously, either your cost of acquisition is too high or your price is too low. And basically, this equation is what the most companies are struggling with. You need to, and this is all the time the balance of this equation. You want to sell more, you start spending more, but then you find out, oops, my actual cost per acquisition is too high, and I cannot break even. And then you start looking for cheaper sales channels. Maybe you find out that the competition is too high, and basically cost per click costs what it costs, and you just cannot get your cost per acquisition down, and sort of you are stuck in this game.
Isn't that in the beginning it's always like this, and then you start to push it down, the acquisition cost?
It goes into jumps. I would say normally in the beginning you should do things which cost you zero amount of money or close to zero. So I would give you example like what is my sales strategy for my startup. So basically, I am working with different startups and companies, and these companies all the time ask me for different freelancers. They say, okay, I'm not happy with my accountant, with my lawyer. Can you find me a good lawyer, or can you find me good freelance developer or marketing person? And all the time, what I do is just I take my phone, browse through my phone book, and call my contacts, and I say, hey, I have a great client. Can you please give me a fee quote on something? And I found out that in Latvia, there's not really a place where you can bring together these freelancers and companies, small companies like startups and small medium enterprises, which need those freelancers. And I figure out, hey, let's build a platform, because there is not such a thing. And how I also what and that's what I'm building at the moment. And what validated my idea was that I went to Instagram and I searched for accountant. And in Instagram, I found like, I don't know so many accounts for accountants and lawyers promoting their services. And I was thinking like, Instagram is not really the place where you can find like accounting clients. That's not really how that works. And that was the confirmation for me that it's a real problem for accountants and lawyers who are starting out and as a freelancers. It's very difficult for them to find their first clients. And obviously, if they are so desperate that they go on Instagram and create videos every day of trying to promote their services, it absolutely would make sense for them to go to my platform, where I can provide them with clients who are looking specifically for their services. So in my case, yes, I am also going through this process. I am figuring out which potential user groups there are for me. Obviously, one is, as I mentioned, these professional service providers who are desperate at the moment. They are on Instagram. So what I can do, in spending zero cost, I can just write the message in Instagram saying, hey, I have a new platform opening up. That's a way for you to make more money. That's an easy sell. Like, who doesn't want? If you came to me and said, do you want to make more money? Sure, take my money. Here, I'm sold. So the value proposition is there. For me, the difficult part would be to onboard the other part, like the companies which would be using my platform to find those freelancers, because I have to, that's not like the typical thing to do. I have to convince them, and then I'm thinking about, okay, what are the ways how I can onboard them, how I convince them, and then I understand, okay, they need a certain features, which the certain feature set, which is currently not in the market. I should make it easier for them to hire this person than the next best alternative, going to, I don't know, LinkedIn or whatever. I should make it as easy to them, so it's a no-brainer that it makes sense to use my platform than something else. So again, that's back to using figure out like what sell, what you can sell with zero marketing cost. Like that should be like number one thing. Like go through all the ideas. extract all channels, I don't know, whatever. First of all, you need to understand, of course, like what is your customer? Is it like businesses? If yes, like certain industries. And then you should also understand, if you are selling to businesses, you need to understand who would actually be making the purchase in your company. And because sometimes it's not one person, maybe sometimes it's more people. And then in order to make a good sale, you need to actually have arguments for all the decision makers involved. So I don't know, for example, you create software for some HR software, which is intended for HRs. So so you would sort of be selling to HR, but not really, because maybe the HR is not the ultimate decision maker. Maybe, and what is more typically, that there is quite often a CFO, finance director, who has to approve the sale. So basically what happens, you go to HR person and say, hey, we have this nice software for you. It will improve your employee well-being, blah, blah, blah. It will do this and that and that. And HR is all starry eyes and yes, we want this software, you have sold it. And then they go to CFO and ask, can you give us budget? Can we make this purchase? And the CFO says, okay, give me the numbers. How much you will improve what? How much something bad will go down? And this is really, you need to figure out this part beforehand. If you are going to your customers, you need to figure out what are their arguments against making the purchase. And you should actually have good answers before those questions are raised. So in advance, you can say, okay, you buy this software, your employee satisfaction will go up by X%, retention would go up by Y%, something else would go down by that and that %. So that's a hard proof. Those are numbers. CFOs understand numbers, and they say, yes, approve. That's how it works. And I don't know if you sell some IT software to companies, to CTOs, same thing basically. You should understand what is their logic, because in the business, as I said, it's pretty much if you're working with businesses, everything you sell, all the products fall into two categories: increase revenue or decrease costs. Yes, and then, for example, in my case, of course, I would go to these, let's say, small accountants, lawyers. I would go to like small accounting firms. I would go to big accounting firms, and for each of those, I would have like a different value proposition. For this, would probably, if it's the small accountants who are just starting out, I would say, hey, do you have difficulty finding your first clients? Here, I can help you with that. I don't know if it's small accounting firms. I would say, hey, you are struggling to grow your business. You are stuck at some level and you cannot grow more. So I say, okay, here's like I can bring you like a new market of clients. For even bigger companies, probably something else. And then I try out different acquisition channels. For example, here, initially I can do it probably on Instagram free of charge by direct messages. Then probably I reach all the possible buyers through direct messages. I need to figure out something else. Maybe I go to paid Instagram ads or something else. For this group, something else, maybe LinkedIn targeting or whatever. But at the end of the day, I measure my cost in all these cases and figure out like where do I break even, where I might make money, where I lose money. And then the game continues. I see like price. So basically, what is revenue? Revenue is how much we make money. So that is price times volume. Yeah. And then that is revenue. And then is cost. And the cost is also price times volume. So I search for combinations where the delta of this is positive, where I have some money left in the process. And that is like sort of ongoing game for all the businesses. For businesses also, as I said, I have a client who is working already for 10 years. They have tried out, let's say, also Facebook ads, Google ads, and it's just too expensive. Like they cannot really break even on their product. So I'm working with them right now with the value proposition, segmenting these into groups, like which industry specifically is using your product and how they are using and why they are using, like what's the value proposition for them. Okay, they have value proposition such and such, let's target them with this message. The other group, they have something else, let's target them with something else. And it's sort of iterative process, really. You cannot just do this and find out it doesn't work, so it doesn't work. No, you really have to you really have to dig deep and figure out like where really is the problem. Maybe for use case one, it would be the case that the value is not big enough for them. Okay, that's fine. So either find out what is the value for them. Maybe you can deliver that value. Maybe that means introducing new features. But then it's a question to you, like, does it align with your strategy? Like, should you build features which are not like the core thing for your product? Does it make sense financially to you build these features? Maybe building these features is too expensive and you will never make the money back. Maybe you instead should go to the group B, where you are very, very close to what they actually need. And maybe you need just to tweak just a few things, and then you are all good. And they would buy your product.
Can I ask a question?
Yes.
Yeah, so all of us are very early, and I don't think there's anybody who has sales already.
Mm-hmm.
So yeah, it all makes perfect sense, but for all these calculations that you need to do, you do need like certain amount of sales, certain amount of tries, maybe not sales in terms of money, but in terms of deals done. So what would be the minimum sort of amount of sales you've done to start really calculating? Because I don't think it's probably valuable to do it on the first 2 sales or something like that, because the data it's not significant enough. So it's just statistics.
Yes, my point talking about all this is go out in the market as soon as possible. That's my key message, what I'm trying to tell you, because like product features, everything, that's nice, but don't like spend too much time on that really. Build some basic thing which you think will fit your client, and then go to actual clients and find out whether that's something they need. Because I would get later to that, but in the very beginning, you are constrained by one thing which will kill you or not kill you, and that is cash. You are all limited by cash, and you have like very, very small amount of funds available. I assume you have not raised money from investors, so this is limiting factor. And you have fixed amount, and you need to maximize that amount. If you spend all that amount on building your product, you don't have money left for making any big adjustments, because you would need to make adjustments. Take that into account. Therefore, because you don't have the product market fit already, you have just an hypothesis what the market would want. You have the hypothesis that they would buy from you, but you are not like certain. Therefore, maximize, go get your product out of the door as soon as possible. Start talking to companies. For introvert Latvians, that is very difficult. I know it's difficult for me, but that's what you have to do. Honestly, it's like there is no other way. The more you talk to your customers, the more you find out what they actually need, what they like, what they don't like, whether they are willing to buy. Yeah, that's my message. And then you launch the product, and then you actually just this is sort of the thing for at the beginning. You are right. It's not so much about this CPA, like volumes, cost, and things. It's more about finding who needs your product, who will buy it, what's the value proposition for them, and how you can reach them. Because it's sort of iterative thing. Maybe the market is so difficult to reach for some reason that you find, okay, maybe there's a value proposition there, but how do I reach them? Like, for example, you're maybe selling to big companies which are somewhere abroad, and you physically cannot approach them. Like, there is no way you can write them to LinkedIn, but they would not just answer to you, you know? So these sorts of things. Yes?
Sorry, the question is too basic, but there's let's say, the revenue, the cost,
Mm-hmm.
but there's also the fixed cost.
Mm-hmm.
Because I learned it hard way that you can have very good margins on your sales, but if the fixed cost is high,
Mm-hmm.
You will not be that profitable again, or just burn the cash. And just the mathematics there is you just have this threshold of how many sales you need
Mm-hmm.
to break even.
Yeah,
It's
yeah.
just that simple.
Yeah.
Or is there something else in the equation?
No, that's exactly right.
Okay.
Yes, and that's another thing. That's a bit later already when you launch the product and when you are actually running the business is running. So it's like ongoing operations, and then for sure, exactly what you said. You have fixed costs, which is basically either you sell something or you don't sell anything, you still have to pay them. 0 sales, you still have to pay for salaries, you have to pay rent, you have to pay for phone, for Google email, or whatever. So, and then is variable cost, which is directly tied to the amount you sell, which is like paid ads. If you produce something, that would be the production cost of your product. And obviously, you need to make, so basically for companies which are producing something, so the revenue minus variable costs is what is left over is called gross margin. And then with this gross margin, then you have to cover these fixed costs, and then you make the play here. You figure out like what sometimes it makes to sell maybe less units, but for higher price, or vice versa. And then you figure out like these different combinations, what should work for you in order that the gross margin is big enough that you actually from your direct operations make enough money to sell to cover your fixed costs. Yes. Anything else? Okay, we can then move on, I guess. Okay, so feedback loop, how the product development should work pretty much. Basically, you build, then you, I would say, try to sell your products. Good if you are lucky and someone buys. Then you get some sort of feedback from your customers, what works and what doesn't, what they want. then you would have like all sorts of different things because each customer would tell you something else. I want this to work in that way with that and that and that, and the other person would say something totally different. So you have to make sense of all of that, and the good way to make sense is like figure out like what problem they are trying to solve, not what features they want to have, but what problem they want to solve. Like why, yeah. So what do they want to do with your software? I can recommend an excellent book here, which is called The Mom Test. How many have you heard? Everyone, very good. I read this book like super simple, down to earth, like super practical. It's not that long. I really suggest like read through the book. Like the guy provides you instruction, literally step by step, and questions. What questions to ask? What questions not to ask? If you ask this question, what will be the outcome? If you ask that question, what would be the outcome? So really recommendation. So yeah, find out, decide which you would prioritize because there would be a lot of noise. You need to understand like that your customers are not always logical and their requests not always make sense. So you need to figure out like what you need to work from your perspective. Like if you're okay, they want this feature, why? What's the purpose? What they are trying to solve? Like if they're trying to solve that problem, could it be a problem for other companies? Is there a way to find out if that's a problem for other companies? And then you prioritize and build and sort of go through this over and over again. Yes. Yes. Next block about VC money, and yeah or nay, because really lots of opinions here, and I want to share my opinion because I have worked with companies who have raised money and for companies who have bootstrapped. So I see how the decisions differ and how these companies develop, and I want to share like my point of view, and then you can make up your own mind. So yes, so positive aspects of bootstrapping. Again, my personal opinion, but I really believe that it's good for most startups, honestly. And there are cases where it's better to raise money, but I would say for majority of companies, it makes more sense. And especially if you are if you are building software, I think it's nowadays. I think it's so cheap to build something, and there is all sorts of government grants, etc., available that you don't need to spend 100,000 euros to to build your like sort of first iteration of the product. So you can find ways how to finance sort of either you get a co-founder who is technical co-founder who can code it for you, or you pay someone. For example, I found a government grant for my startup, and I can pretty much build the MVP with that grant without spending my own money, like zero cost to me here in Latvia. So it's you just need to look. There are ways really. Go to LIA, talk to them. There are like options and lauku atbalsta dienas, whatever. Like just do your research. It's possible to get like. I think unless you are doing like, unless you are building something like very, very complicated, which has not been done ever before in the world, or which is so high tech, you can get by with these grants or whatever state or EU fund options there are. Especially like if you are building some military product, like the money just gets thrown at you pretty much. Just an idea. If you want to pivot to military, now it's a good time to do so, because the money is very easily available there. So that's the thing. Yes, so because money is available, I believe that for MVP, you don't need to really spend so much unless you're building something very, very advanced. Also, for physical products, there is this LIA voucher of 20,000 euros, which lets you build your prototype and everything. I think that's in collaboration with RTU, Riga Technical University, and they have the lab there, and they would like the build thing for you. So options are there. Yes. Next thing, which is I think very important, that you are very focused on making money. And actually, that's a good thing, because if you don't have external money, you pretty much have to do everything to survive. You know that there are not like rich uncles with deep pockets where you can raise some money and then you can raise again. So your mindset would be forced to work in a business person's way, how to actually make money. So that's, I think it's a good thing. Because I would touch upon that a bit later on. What I see for VC-funded companies, that the mindset is a bit different there, honestly, and sometimes not in a good way, because founders are they are used to these external cash injections, so they sort of develop their business with an idea in mind how to raise the next round. So the company is built for raising the next round, and that is not so good, because they focus not on the business case, not how much the value maybe the product provides, but for reaching certain metrics, which are not necessarily related to business potential of the company. But I'll talk about later. Yes, the next thing, you can do whatever you want, and if you are bootstrapping, because like there's no investors behind you, and you can make whatever decisions you want, how bad or good, whatever. Like no one is telling you like don't do this or that. Of course, investors like they would not be very involved in your business. Like they would not tell you what to do or what not to do anyways. But still, you have this accountability element that every month or every quarter you have to report them. Then they ask you questions. No, it's a bit, in a sense, it's like having a boss. And if you left your job to build your own company, then what's the point of having a boss again? It's sort of, I don't know. I don't like that too much, but yes, you have no reporting or tracking metrics, which is maybe a bad thing, because again, if you have investors, they would be asking for you every month for certain metrics. Then it's a problem, of course, if you don't hit those metrics. But still, if you are running on your own, no one cares. It's all up to you. If you don't measure the right things what you should be measuring, bad for you. But that's what it is. And you can go at your own pace, which is really also a nice thing, because you can then regulate yourself. Like it's not like these, okay, I have raised cash for next 18 months, and then I have to do everything in mind what I need to reach in those 18 months. Sorry. Then, if you want to raise VC money, the good things are you can pay yourself a salary. And honestly, I think that's actually an honest reason why people go to VC, because you bootstrap, you start building your business, you sort of do it on weekends or on evenings, you sort of try to combine with your daily job, and at some point it just gets so tiring, so difficult, and then you just say, screw it, I will just go raise some money so I can just pay myself salary, and then I can 100% focus on building my business. I think that's an honest answer, really, what people do. Yes, you can afford some paid marketing, which is also nice, so you don't have to do crazy inventive things maybe, but again, there is value in doing those crazy inventive things in the beginning, because I think sometimes you get much more information and insight about the market than you would get just running the paid ads. Yes, it is. VC money is very good once you hit it off, and because companies need money for growth, really, and you can get like a big sum of money which you can just immediately put into growing. So that's a good thing. But that's, I think, once you already have lifted off and you have good traction and you see the market is there, I just need more money to approach bigger market. And that's and you see actually that lack of money is actually limiting your growth. So then it makes sense to raise some funds. Yes, it forces you to care about certain metrics like customer acquisition cost, like long-term value, lifetime value, and sort of you measure things. You know which things you should measure, what is important for your business. You track those things, and actually you understand like where you should focus, though. So you learn something. So that there's some positive aspect as well. Yes, and sometimes depending on the VC and depending on like which industry they are serving, they can provide you with good leads and intros. And let's say you want to approach healthcare sector, and if this company has already investments in healthcare sector, they can give you warm intros to I don't know, representatives of those companies, which would make your sales like much easier. So that's a good thing. Yes.
Just more on previous on
Yes.
the bootstraps. I mean,
Mhm.
kind of mentioned the grants, and
Mhm.
I mean, from maybe I have not done sufficient research, but my
Mhm.
impression so far has been, at least for such an early stages where we are, we're mostly eligible for another basically those non-cash benefits of mentors and so on. I mean.
Be creative.
Yeah.
Be creative.
Okay, so that's
Yes.
it is.
It's possible. You just need to be creative. Yeah. Okay. So for VC funding, one of the perils is like, as I already touched upon, it's a bit like parallel realities. So one reality is selling your product, focusing on break even, like building the business, etc., etc. And then the other reality, if you go into VC world, is that you actually focus on something else, and that is chasing vanity metrics and what you need to do in order to raise the next round. And what I have personally seen is that these companies, not all of them, but sometimes they just strategically they start to do such strategic things which from normal business perspective they just don't make sense. And for example, one company I worked with, they have a pretty good business model, and it's sort of breaking even. But when you go to the VC for VC money, basically why VC would invest in you? Because like you have a potential to become a unicorn. The thing is, there could be just so many unicorns in the world, because the unicorn, in order for you to be a unicorn, you need huge sales, and in order to have huge sales, you are back to this price times volume game, which is sales. Yeah. So obviously, either your price is very high, but it would be like very rare cases, unless you are selling some very specific products like this. What is this American company which provides some? It's like not military but intelligence services. It's Palantir, exactly. Yes. So the price, they probably don't have very many clients, because who is buying from them are probably governments, but the price is huge. So they have very big revenue. Or you have to have huge volume. But huge volume is possible for something which is used by pretty much everyone. And honestly, in the world, there are just not so many things which are used by most of the people. Most people, what is used by everyone? Food, transportation, some space where you need to live, and entertainment. For example, Spotify, Netflix, like obviously there's like a huge volume because like pretty much all of us we want to listen to music or watch some kind of video content, so the volume is there, but there are really just not that many products which can hit such a huge market. And for business products as well, for example, one good example is Canva. They probably didn't think about it, but it lifted off, and it's really used by, I don't know, the market is huge because like there was a real need in the market that just wasn't, people haven't figured out that there's need for a very simple designing tool. And I don't know, secretaries in companies use it, and marketing people, and so many people really use it. So the market is huge, but there are very few such products, and that's the sad reality. Why VCs invest in the companies, because they cannot know, for no one knows for sure which would be the next Canva or Netflix or whatever, or Airbnb. By the way, if you have heard the Airbnb founder story, basically like they went to big Silicon Valley investors, and like no one believed them, and people pretty much laughed about their idea and said that it's all bullshit really, and who would want to stay at someone else's home? That's like creepy, to say the least. And still it became huge business. So that's why VCs invest, because they don't know what will be the next big thing. So but if you look at like realistically looking, most businesses don't have this unicorn potential. But if you want to if you want to raise VC money, you have to go to the VCs with a story which proves that you have unicorn potential. And you raise some money, you start doing business, something hits off, but in order to raise the next round, you have to show that actually, okay, we are moving towards this huge market, and that's where things go bad, because you find your sort of one thing which you do good. Instead of building on that thing, what you start doing, you start chasing other things, which unfortunately are not good. Also, for small companies, it's impossible to chase many things. That's the luxury of big companies. Microsoft can have 100 products. They're a huge company. Google can have many products. They're a huge company. We, the small companies, the startups, we have resources to build one product. That's it. If you start building many, the mathematics just don't work. You just, as people, we don't have like mental capacity as a founder to like launch like 5 different products. It's just which are all different. It's just impossible. And that's the very, very bad thing which I have personally seen. And I talk to those guys and say, well, look, guys, you have a perfectly fine business model. It's working. You're making money. Why not build on that? But we have to raise the next round, blah, 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 and this and that. And we have to prove that this vision, which we told about our investors, that it actually works. Otherwise, they wouldn't give us money, blah, 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 and so on. And basically what happens is just screw up a perfectly good business case, unfortunately. Also, another company I was working with, the same story, also perfectly fine product, but no, they raised VC money, and again, like promised some, I don't know, rainbow's vision of what we will be one day. And again, instead of like building on this, what they are really, really good at, no, let's start building something else, going into different markets. Of course, going into new markets like of these product segments. Trying to start with a new product segment, it takes enormous amount of energy for you to figure out what that segment is, how to approach them, what's the value proposition. It's all done by the founder or founders, and if they are doing that, obviously they cannot focus on anything else. So that's bad thing. I also have good examples. I have one company which raised just one round of VC money, basically to get the company going, and that's it. And honestly, they are pretty chill about that. They say, we don't care about like being a unicorn too much. We are doing pretty good. We are growing 10 to 20% per year, which is not venture capital scale by far, but still they're making money, they're improving their product, so all good. So that's an excellent example. Should we have a break? What time it is?
11.
Okay, can we continue? Good. Yes, so about VC, some good things, some bad things. Maybe you can change the next slide. Yes, there are some toxic effects of VC money, and one is I already mentioned, chasing the impossible. You promise something to investors, which in real life is unfortunately not really possible, and then you start chasing the wrong thing, which can have quite bad effects on your business. You start chasing vanity metrics. This is again, I mentioned, maybe not focusing on profitability, which like should be one of the key things a company should try to reach, trying to actually make money. Instead, they are focusing on other things, such as building these and these metrics, reaching these and these goals, so which are not maybe related to the business case. All focus on raising the next round as well. And another thing which I noticed working with companies which are VC funded, this money raising process is very, very time consuming, and it really takes a lot of the time from the founder. And for these companies which are on this external money needle, if I can say so, every year when they have to raise the money, I think they spend at least 3 to 4 months focusing only on that. They reach out to investors, they do the tours, they meet them, etc., etc. Then there is some sort of due diligence process, which is also very time consuming. The legal part of that, which is also very consuming in the banning. So 25 to 35 of your time, you would not be focused on building your business. That is like for sure. Yes, also it can become addictive. Also what I have seen, and it is some sort of ego effect, which you have. It's if someone gives you millions of money, you see that, okay, you are worth millions, and I think it takes a very strong person to not that allow to go to your ego, and it sort of you start of this game. Okay, now I raise this and this amount of money. Next time I raise more, so I am more valuable. But then I want to raise even more, because you sort of build your self-worth a bit around this situation. And I have seen that as well in some founders. Yeah, that's interesting thing. And last thing, be very careful with investment terms, and that's the thing when you raise your first round, and especially if your business case is maybe not so good, or you don't know how to present in a very promising way. Maybe the investors wouldn't believe in your business that much, and they would give you the money, but the money would come with not very favorable terms. And that is a thing to really look out for, especially like when you are running you're like raising your first round. I think the typical rule of thumb in the market is that you do not give away more than 10% of your equity. If you give away more, it would be difficult for you to raise further rounds, because you have each time you raise money, you give away some part of equity. And if you want to raise 3 or 4 rounds, for the last round you would not have left any equity to give away, which is quite bad. And also for you as a founder, at some point where you do the exit and get the big paycheck, it could turn out that there would be like no paycheck left, especially if you all is like fine and dandy if you really build a unicorn, because like you build a billions worth company, you exit, you get your billions, and everyone is happy. But again, statistically, that would be not the case for majority of the companies. So maybe you would exit, but the exit would be like, I don't know, 5 to 10 millions. And then if you are left with just 10% at the moment when the final exit happens, and you are left like and your part of that is like 500K, and then you figure out that you have earned 500K for working like 15 years with no salary, almost no salary, and then you divide it and figure out like what's your monthly salary is based on that, and you would find that maybe it was actually better to have a paid job after all. So that's something to consider. Yes, about investment terms also, it's a bit when raising later rounds, because companies, I think also often companies find out that they are raising later rounds in the situation when it's not very favorable, either as it was last year, where the valuations were really going down because of the market turbulence, blah, blah, blah. The interest rates went up, so money became more expensive. Investors were much less willing to invest, so it was much more difficult to raise money. And then, especially like if your business is not doing that good. For example, I recently worked. I had a client in Lithuania, a startup. They are like working for 5 years or so. Like they have like normal business case, and they have paying clients, but still like I think they have fallen a bit into this venture capital trap. Like their monthly revenue. Their monthly revenue is approximately 70K, and their costs are around 200K. So basically, each month they are burning like 130K, which is quite a lot. Like that's 1.5 million euros per year, and I help them and I say, guys, like, look, you have money left for like 4 months, really, if you're going at this pace. And they said, yes, we are raising soon. And I said, oh, well, okay, like you have, like they're burning money like crazy, because again, they are chasing this unicorn story. They have hired like a huge team of very expensive professionals, like developers and whatnot. So they are building like all sorts of complicated things instead of maybe focusing on finding out like this one really customer group which fits the best, and on which they can expand. And I said, okay, like if you need to, if you want to go on for another 18 months, like this is the amount you need to raise from your investors, and it was like 1.8 million or something like that, with the budgeted costs and everything, like all the revenue growth and everything. So they said, okay, yes, sure. And they went to investors, and investors said like, look, guys, well, we will not give you that amount of money. Like it doesn't make sense. And because like, again, they were struggling to show really big revenue growth. And that's like, that is one of the things, obviously, which venture capital funds are looking for. Like if you have like 100% growth year on year, like for sure you would be able to raise money. That's like a good indicator. Because obviously there's a reason like people are buying your product, even maybe you're burning money, still there's a business case. For example, Spotify, which is now like a 22 years old company, they started making money just 2 years ago, I think. For 20 years, they were burning money. They were loss making. And because in their case, the business case is obviously there cannot be like 100 streaming companies in the world. There is market just for very few, and we want to be the streaming company. So they spent a lot of money in order to be the first, to have the most market share in all the markets, not caring too much about the profitability. They were making huge losses year on year, but they were showing the revenue growth, the user base growth. And that's why investors gave them money, because they bought the story. Okay, that makes sense. It takes a lot of money to build the user base, but once you are there, once you have captured the market, then you can start making the profits. Basically, you buy the user base, and then you can get revenue until pretty much infinity from the user base. Yes, so, and then you go to investors, and if they don't see this meteoric revenue growth, then obviously either they won't give you the money, they won't give you as much money, or the money would come with unfavorable terms. And for example, unfavorable terms are liquidation preference, which is basically normally investors say that, okay, we give you money, but when we sell the company, or the company, for example, is liquidated, we are first in line to get our investment back. So in a sense, they structure their investment a bit like a loan, like a financial instrument. So if they give you like 200K money, they say, okay, we want to have liquidation preference of some multiple of this amount we have given. And sometimes the multiple can be quite aggressive, and normally it would be range from 1 to 2, but sometimes it could be more. And last year, I read a company in the US, a startup, and they exited. They actually made a sale, and and their last round they raised, it was the liquidation was such high multiple, this liquidation preference, that basically the company was sold for, I think, $500 million. That was the sales price. And due to this very high liquidation preference, all the investors got their liquidation preference, and these founders, which were building the company for, I don't know, 15 to 20 years, 3 or 4 guys in total, they received 500K out of this. Real story. Yes.
What kind of company? Software?
Software, yes. Mm-hmm. Some B2B, SaaS, something. I don't remember what, but.
So how negotiable are these preferences in which terms they are negotiable?
Negotiations are
in the multiplicator.
Negotiations are negotiations.
Yeah.
What is your cards? What you can play is your business case. So if you focus on your what you can only show is your business case, your revenue going up. That is your strong suit. I would probably say, like, if you are in a tough spot, I would say think really twice if you really need to raise money. Maybe better cut costs, rethink your business model, figure out how can be profitable, and restart from another point. I would say logically it would make more sense. So liquidation preference, anti-dilution, that means that sometimes investors demand For example, when the new investors, like for example, you have like 100% in the company, then some investors in second round come and they have 10% and you have 90%. Then you have another round, so you are left with 70% and they have 30%. And sometimes they ask for non-dilution clause, which means that when new investors come, normally, like if you want to add someone on board, both these parties would have to give up their shares. But they say we will not give up our shares. Only you will have to give up your shares. So that's sort of that's what they demand. So also these all sorts of things which you have looked out for. So yeah, I think it makes if you are serious about raising money, I think it's worthwhile to consult with other startups who have raised money and ask them about these clauses, like what is good, what is not good, like what investors typically require. To answer your question about negotiations, what can you negotiate about, what you cannot negotiate about, and yeah, think about, I would say, like focus more on building your business than being in a situation where you have to accept like really unfavorable terms. That's, I think, more expensive. Any questions? Okay. Yes, there are some cases when it makes sense to raise money. I think in general, one of the rules of thumb is when you are actually profitable, when you are already making money. So you need probably money to grow, to put already into market. You just want to grow your market share. You probably want to hire some salespeople. For example, you're working in Europe, now you want to go to US. You need to hire some salespeople there. You need to invest money in paid marketing. So you have already proven your business case. It's there. You're making money. You just need fuel for growth. And obviously, that relates not only to startups, but pretty much to any business, any company. The better your business looks or the better it's performing, the higher price you can ask. So always the deal terms would be more beneficial for you if you are in better shape as a business. You can always get favorable terms. If you are desperate, you would always get shitty terms. That's just how life works. Yes, so we already touched about the extra funds. And the third case is in rare cases, if you are so unique, your product is so unique that you just cannot build it with external money. For example, some biotech company or something you need to have like R&D for years and years, which is very expensive, some licensing, whatever, something else. Obviously, you cannot do it with your own money. It's just not physically possible. Then you have to raise. But then again, you have to go to these VC funds, which specialize in this sector, in for example, biotech companies, which understand what is the licensing, why the process takes so long. So actually, they understand the risks and they are willing to give you money. If you go to the company which doesn't work with these sectors, they just wouldn't understand the risks and like, yeah. Yes, and the last one for, as I said in the beginning, if you are, let's say, too tired of doing this bootstrapping thing and you just want to give you this one shot at success and make it or break, and you say, okay, I would take this investment and then I do my best. If I achieve success, good. If I fail, then I fail. But I think that's the philosophy which you should adopt. That you have, I think you should have like very clear purpose why you are raising this money, what you want to achieve. Like one of the purpose could be, okay, I'm raising to have this one shot at success, and then you do everything. and you sort of need to define yourself criteria. Okay, like what's the criteria if I'm successful or not, and not fall into this trap. Okay, I raised money once, and then the money is running out, and you sort of still haven't got the product market fit. Maybe you have some revenue, but most probably you are struggling, and then the easy way out is going to the rich uncle again and asking for more money. But yeah, but I think if you have not really figured the business case, that's not a good strategy. Obviously, it's good. There are some specific cases where it is good, and if it's like obviously the Spotify case, where once you have figured out you are growing, the market is huge, you just need to pump money in, like billions and billions to grow. The same story about, I don't know, have you ever used such a website, house.com, which is like interior designs. Like if you are building or modeling your apartment or house, you can go to house. It's written like this, I think. House.com. So basically, they have like photos from different interiors and exteriors, so like you can get ideas. But they started in the U.S. and because it was like a couple, a husband and wife, and they were remodeling the house, and they found out that it's impossible. Like it's very difficult to find the good contractors who would build your house. Or a model or whatever, and because like references play key part, and you don't know like whether the designs are okay, like for interior designers. So they created this website where like contractors and interior designers, they put photos of actual projects they have completed. So you see how the company is working, you see their style, you know whether you like them or not. For example, this interior designer, and then you can sort of reach out and get a quote. So it's sort of a marketplace which brings together both parties, and it solved the problem in the market. Like renovation or building house is like a huge and costly project, and the risks you have by taking on the wrong person are very large, and they sort of alleviated this problem by having these that they could show actual projects, client references, and yeah, and you could reach out to them. So and basically they were bootstrapping from the beginning. They built somehow from their own money. They built the website. Technologically, the product is not complicated. At first, it was not complicated. It was just like a catalog of different companies, and and portfolios. They just show their portfolios, and that's it. Like, and you could like message them or something. And they were bootstrapping. They were doing this in parallel to their day job. They were just going to. They were onboarding their clients. Their clients were these construction or designing companies. They went to these. They had meetings with them, showcase their products. Hey, do you want to onboard our platform? Blah blah blah, and so on. And they were actually growing pretty good. And of course, they started growing, and investors noticed them and came to them and said, hey, we want to give you money, and so on. But they all the time they said, no, we don't. We just want to build with our own money. We want to bootstrap, etc., etc. And then they had a family friend, which also was an investor, and he said, look, this is my suggestion as a friend. You can take this advice or not. And he said, I'm willing to give you my money. You can take it or not take it. But I think what you are having is a problem of a real risk. And the risk is that you are having a nice product. It has traction. It's really lifting off. It's becoming popular in many states in the US. But the problem is, it's quite easy to copy. And one day, someone will copy your product, attract investor money, and spend huge amounts of money in marketing, and you would just lose your market share. And that is a very real risk for you. So my advice is take investors' money. Okay, there would be some dilution, but it would ensure that you would be number one player in this market. And actually, that is what I did. And later on, I was listening to an interview with her, with this woman who founded, and she said, yeah, that was absolutely the right step, because sometimes it's not about just whether you need the money or not, but if you need to think about in longer perspective, in 5 or 10 years, like what happens if you don't raise, like where will you be? And especially for companies which have a product which can be easily copied. For example, if you have product which is like very specific, and this is the case for, I don't know, for B2B SaaS products, and this Lithuanian company I helped, they have a very specific B2B SaaS product which takes long time to onboard, and you have to really integrate it into how in your client's company, and basically afterwards it's very difficult to switch out. So they don't have to really worry about such type of situation, because once the client starts using their product, for the client is very expensive to change that product, because it becomes so ingrained in the company operations. But if you have like B2C, where it's easy to copy or something, it's not trademark protected or something, yeah, it's one consideration you should have. Yes. So you asked me during the break about the cases, the good,
perfect scenario, normal scenario,
and bad scenario. So for raising money, yeah, the perfect scenario, you are growing like crazy and you just need money for growth. That's I would say, perfect scenario. Normal scenario is, I don't know, probably this. Take for this one shot and then make this decision for yourself. Okay, I will take money just once to see if I can prove this or not. If I can prove the business case, fine. I continue by growing on myself, not attracting any external funds. If not, then sorry, it's just lost opportunity. But that's it. And the bad case is like if you are, it's always if you are bad situation, and if this is like if you're desperate. It's like the desperation is always for bank loans or for investment cases or selling companies. That's yeah. And I have been in companies in cases where it's really desperate more than once. Unfortunately, not unfortunately, it was a very interesting experience, but it's yeah, it puts you really in a tough spot, going to investors and putting a smile on your face when you know that your company is actually burning in flames, and trying to squeeze out some future potential business case which you can show to your investors. That's really tough. Yeah, that's really tough. Mm-hmm. Yes, yes, finance basics, finally. So again, finance, I view it as just a tool how to look at your business case, and that's really just an instrument. And actually, I would say the finances and numbers are really the last part, what you should do. And actually, it's really difficult to make your sort of business budget or financial model unless you have pretty much all the parts figured out. That's sort of the thing. I worked with one company half a year ago from Riga Tech Girls, and she was also building product, and she wanted to go to the big accelerators in the US, and she asked me for help to build sort of a business model, a budget to figure out like how much money she needs, when she would need, for how much it would be sufficient, for how long time period it would be sufficient. So we started working with her, and after months, basically, we had to stop because she said, like, look, I have to figure out my business model, because I really cannot, like, we cannot build the budget or the business model because I haven't figured the process out. And you really have to understand all the parts, how all the parts of the business would be working together, because out from that you would get like how your revenue stream will look, how your cost structure will look, everything. If you don't have that, you can just play around with numbers, but these numbers would mean nothing really. So
Funny thing, I recently read about the SCB Bank grant program, and one of the key points to get this grant financing is to have a physical business plan of revenue, etc., etc. When people, so as you say, it's hard to even imagine. So it's mostly fantasies.
But you know, it's I think at least in the early stages, it's all like pretty much guessing, and you don't know anything. But do the budgeting, build the model, but not for the numbers, but for the business process. So you understand all the key parts and components which should go into business. And they would change many times, but still you need to understand the critical parts in the business, like which components should work together in what way, so you can make it going. That's the key thing. Like obviously the numbers will, it's a pipe dream, it's a fantasy. Like you cannot really, you cannot guess these things. It's only once you start actual real life experience, only then you can figure out what it will mean. But just for the sake of business model, that's very important. Even for companies which are growing and already generating some revenue, even for those, like I would say those budgets or how you want to call them, they don't make much sense, because the real life is much more different. Very precise budgets can be made for big stable companies. Rimi, Maxima, Latvia's Gāze, they know pretty much like how much cartons of milk would be bought next month every year. Like they know for sure, but in startup world that's impossible. That's sort of, maybe I would say one thing is use it as to understand your business model, to figure it out, and second thing, sort of trajectory where you want to be going approximately, sort of that's, and then you can measure against that, like how far you are off from that, and then you can see in which parts you are off, and then you can make some corrections. Only that purpose. Yes, and finance is really for small companies, it's quite simple. I would say I would walk you through like a very basic accounting and finance things, so you in general understand where the numbers come from. But again, for startups, it's so simple. There's like it's a very simple thing really. For the more complex you get, then the finance part gets more complex as well. But the smaller you are, it's like very straightforward. Yes, let's move on. Yes, and for how much actually you need financial complexity. Yesterday, I was downstairs on the second floor. I talked to founder of, I think it was Ruga, this what is bike with track, yeah, Eric, his name, and basically I said like I'm running a workshop tomorrow for StartSchool, like about finances, and I asked him like, what's the one suggestion you have as startup founder, and he said, cash flow. Focus on your cash flow. Really, that's also what I mentioned in the beginning. That's the key thing. He said basically, focus on your cash flow and focus on your R&D. Like figure out the way how to get your product out in the market in the fastest and most efficient way. So, from for a startup or a young company, like cash is really your lifeline. If you have cash, then you have some lifeline. If you don't have cash, then you're pretty much dead. So you need to really understand, like, okay, I have this and this amount of cash, even if it's just your savings and you are just using these savings to develop your own product and you are just not getting any revenue, then you should figure out, okay, I can survive for this and this months on my own savings without revenue, but at this time I need to start bringing in some cash in order to survive. Yes, focus on cheap and most effective sales channels, which I said in the beginning. Try out all things which cost zero money or very little amount of money at all. And the challenge is not to die, really. And that is the most, what you should focus on. Find out ways how not to die. And the good thing is you become very creative because you have to find out ways which don't cost any money. So you can find some very interesting things. Yes.
People in the chat asking, we have planned the lunch break at some point.
What time it is? Yes, maybe let's have a. I will talk for some 10 minutes and then let's have a lunch break of some 45 minutes and then I don't have that much left to talk. So after lunch, maybe half an hour or hour, and that's it. Yes, so financial basics to run a company is pretty much like cash going in and or cash going out, and that's it. And you start with some amount X in your account, and then you need to just figure out like how long time you have until this runs out, and you have left with zero, and that is pretty much your job in the early days, and also. Thank you. Yes, so again, for these guys, something else. These guys leaving there, they were probably, we found out that in some cases they were overgrowing our platform. So we decided to give them sort of IT priority for their requests of new features and some special treatment, basically. So they are more loyal to us. They get what they need, and they are more motivated to stay. Yes, what did I want to say? And what else we did based on that? We could actually already, in a predictive way, based on these parameters, how well these customer groups are doing on our platform, we could predict which of these are likely to churn. And that gave us opportunity to already proactively start working with these groups before they churn. So we already start the messaging. Hey, are you having difficulties with this and that? This is how we can solve that for you, etc., etc. So that's a story about subscription model and problem of churn. Next.
There are some comments in the chat.
No. Just about recording.
Okay. Yeah, sure.
So have you ever had clients where you look at this churning problem and you just see that maybe the issue that they're solving is not significant enough? Because there are actually two things you could do when you look at these rates. You could do all the things that you did and you were successful for your clients, but sometimes maybe, yeah, it is just the case that people start using a product and they just realize that they don't need it because it's just not important enough. So how do you know which one's which? How do you know if you should kind of put more effort into talking to the clients and maybe adjusting your strategy, or when you should pivot to produce something more impactful?
I would say in general, if like all of your clients leave like pretty much after 2 months, then it means that pretty much like no one sees value in your product. And that's that. If there are a bunch of people who stay, obviously they get the value. So the question is, go to those guys, talk to them as much as possible, find out what is value for them. So obviously there is some value, because if people are giving your money to you and say, okay, I want to use your product, obviously they're getting something out of that. And then you probably need to figure out like, okay, what's the value proposition? Like, how I serve these clients good because I solve that, that, and that for them. So I figure out, okay, what should be, I don't know, what client segments or industries these are, which I serve the best, which find the most value from my product, and figure out like how I could find more of those. And for those 90%, like they see no value in your product, I don't know. You could try to find out. There is probably a reason, but I mean, there is some issue, just not a good match. Either they didn't have the problem was not big enough, or something.
Too good of a sales guy.
Yes.
There's a lot of speculation. You can maybe say maybe the messaging behind the product was not truthful, and there's 10 different ways probably how it could go.
Yeah, and honestly, I think marketing is a big issue as well. I think you really need to think about your like this product positioning and what you say in your pitch to your client, and you need to. I always say know as much as possible about your client, and know basically how he operates, like what are his needs, like what are his issues, because the better you understand, like the better you can tune your value proposition. I think that's always a valuable thing. What else? Okay, so next one is a freemium model, and often it's I would say some combination of subscription and freemium. Normally you have like a free plan for most, I don't know, B2B SaaS services. You go and there's typically a free plan, which is a nice thing, because I think the good way is to do like provide to your clients, I don't know, 2 weeks like full functionality, so they can like fully test out the product, and then they sort of know if it works for them, and like after these 2 weeks, okay, it's sure that it fits them or it doesn't fit. Or you can have like a maybe that is for more consumer products, like you have like a very limited like a free version, and if you have a sort of more functionality, bells and whistles, then you sort of upgrade to other plans. But again, you have to really understand who are your customers, and I don't know, like you have to really think about it. For example, if you sell to startups, and the harsh reality is that like most of them might not upgrade to a bigger, to higher plan, because like maybe they don't grow and they just have enough of what you're offering. So be careful with your initial offering, and changes in pricing. I can tell you from experience that changes in pricing, clients don't usually take very well. It's unless you provide everything cheaper. Normally you don't. Normally you do changes in pricing when you see that you are not making enough money. Changes in pricing typically means that you want to extract more money from your clients, and the clients are always pretty much pissed off about that. So yeah, so maybe in the beginning when you just start out, maybe it's not so bad, but later on when clients have been using for product already for a while, and then you come with this new pricing model, then it's a bit nasty. So freemium, good, yeah, also for SaaS mobile apps, and products with low entry barriers, which is like very easy to test out. Yeah, good is that you have a user base growth. So I mean, it costs me nothing to try out the product, so why not? I can try it out. But then again, the downside of that is how do I convert them to paid? And that could be a real issue, a real struggle to you, depending how you structure your pricing plans or tiers. tiers. That is good for some software products which you sell to businesses, because then you somehow can segment your clients, and then you sort of you can segment your clients or market and sort of provide good offering to each of these segments. Let's say I have small enterprises which need these functions. I can provide those functions or whatever for lower price than bigger companies. They need different feature set, so that costs more. So you could cater to each of these categories. The bad thing is it gets somewhat complex, I would say, because still you cannot perfectly segregate between each of the segments. There would be different industries and the use cases would be different, and you cannot make these perfect divisions. Like this group would be most happy with that group would be most happy with that. So there is some downside to that. And I would say that yeah, one of my clients actually, they had these tier based pricing, and in the end, basically it got so complicated because you add new features, and there is one fee for this feature, another fee is for that feature, and features, and then there are some limits. Okay, if you use this amount from that, then you pay that. And it's just so much time is spent on both sides just calculating what should be the monthly invoice, that it really gets complicated. So they went to a different pricing model. Clients were very angry, but they sort of simplified down everything. Then there's usage based. This is if you provide a service which you can very exactly measure amount of service you provide to a certain client, also from B2B SaaS or whatever, like cloud-based services, APIs, where let's say, I don't know, you do API calls where you return, I don't know, some calculations for them, or I don't know, something which is measurable, which is yeah. So clients pay per use, how much they use. They basically they pay per actual usage. So it is sort of a fair model because you pay only as much as you actually use the product. But also, yeah, it's actually for if you are, that's very good marketing point for smaller customers. You can much easier attract smaller customers because they would pay probably very little for you, which is sort of it's not a hard sell, but then again, you don't maybe make as much money from them. But then again, if you should know your customer base very well, and if you are quite certain that the usage will go up, then you can make this bet and operate in this way. Yes, but the revenue can be quite unpredictable because your revenue fully depends on how much your clients use the product, and you have no control over that. And maybe especially if the product is sort of non-linear usage, or the client's business is sort of not very linear, then the revenue could be all over the place from month to month. And complex billing, because I don't know, depending on how complex the service is, it takes probably some setup of how we calculate what the usage. We need to make sure on both sides some transparency. We should provide to our clients, okay, you used this and this amount. They should be able to check on their side that this is actually the amount of API calls they made, and so on. And one-time fees, which is I would say the business model of old days, where you bought Microsoft Windows or Microsoft Word, and you just paid once, and then you used forever until you wanted to buy a new version or whatever, which is maybe okay for some bigger advanced software for companies. Maybe if it's very specific, expensive to build, so you can take a quite large sum of money up front because you sort of deliver the value in the beginning. So good thing is immediate revenue, but then again, no retention, and basically you have to start each month from zero. You make sale in January, then February comes, you again have to run out in the market, start from scratch. I will pretend that I push the button and you change the slide. So why everyone loves subscription? Why is everyone, including Microsoft, converting to subscription model? Basically, it's cash machine. You sell to customer once, and you get revenue forever, pretty much. Of course, you battle the churn issues, but I mean, if you use Microsoft Word in a company setting, it's pretty much you will use it forever, more or less. So that's why it's so attractive to more or less all companies, because it's very stable, predictable cash flow. The only thing is it's a bit tricky from cash flow perspective, because the thing is you need to spend a lot of money to attract the customer, which is like, I don't know, let's say 200 euros client acquisition costs, and then you get like 10 euros every month in subscription fees. So basically, you need a lot of money up front, and you get the revenue for that only much, much later. So from here, the cash flow thing really hits you, because you cannot really generate this amount without having a lot of money here. So this is this problematic element where you need to figure out either how to make this much lower, or somehow play around with the pricing so you can actually break even and you can afford these sales. Or you really go to a VC fund and say, okay, my model is working, but I cannot afford this part. I like money for this part. Yes. Okay, so predictable revenue, you have relationships with clients because it's sort of long term. And as you know, with subscription services, you can increase the price, and it would not have like hugely negative effects, because like, I mean, clients are used to paying, I don't know, 10 or 20 euros per month. So, I mean, if you add 1 or 2 euros, it would not be like the end of the world for them. That's a good thing. Let's do pretending part again. Yes, so about cost parts, revenue we more or less discussed. So costs, so this is something that we touched upon already, about fixed variable costs, direct or indirect costs. So basically, if you have a physical product, there is some cost which you have to incur in order to actually produce the product. And then that's the question, whether you produced yourself and you bought machinery to produce it, or whatever, you have some people to do that, or you outsourced and then you're buying it from somewhere else. And I think then one yes, we already touched upon that. So basically, you have revenue, and you have then variable costs. And as your revenue goes up, your variable costs also go up. So the margin goes up. So variable costs are the costs which grow in line with the revenue. So these could be, if you produce physical product, that would be like production costs to produce things. If you have a digital product, if you do, I would say the closest to that is digital or paid advertising. That's the thing. The more you pay, hopefully, the more customers you attract, and it should go more or less in line with your revenue. Yes, also, we can define it for some companies. For example, for this Lithuanian startup, we put under these direct costs. They have certain provide certain services in order for this product to be accessible to customer at all. And they have to run a number of services so this product is accessible. So they have to run some specific servers. They have to, I don't know, they have to have like certain people who do the onboarding and something else. There are like many elements. So we treated these costs which are necessary, without which the product is inaccessible. We treated them as direct costs. Who's coming? Yes. Indirect costs, which are more or less fixed costs like salaries, rent, marketing, which is maybe not directly related to sales. Like, for example, you go to some events or exhibitions and stuff like that. So yeah, that could be indirect costs. Why do we have to split costs at all? The purpose is actually for you to understand, first of all, where your money is going, how much, and for you to understand how you can make better decisions. So, for example, if you have a digital, for example, for this Lithuanian company, the customer onboarding costs are very high. So they had to track specifically each month these costs, because that made quite a big part of their total costs, and they wanted to make sure that what they earned from their customers is more than they are spending on onboarding these customers. So from business perspective, you need to track those costs in a such detailization which makes sense for you. Again, there is no like universal answer to this, but you should split. You should look at your finances in a way which helps you understand how your business is performing. And therefore, there would never be like a single universal answer for everyone, because this revenue and cost structure would be pretty much unique for each business. There would be like not a single, not one universal thing. So, for example, if you serve like I don't know, B2B and B2C customers, I would say you would track revenue of these two. You would split your revenue in two groups, like how much, what is the volume you got here, what is the price they paid. The same for B2C, volume, price. And then obviously you would need to split your costs in the same way, so you know how much you got from each of these groups. Because if you throw everything in one bucket, it could be the situation that you are making money here but losing money here. Sorry. So it makes sense to like really think about like what is your business model, what is your customer segmentation, and build your finances around that. Yeah, so that's about costs. So yes, now it works. Yeah, so basically where it all ends up, and this is like what your accountant will provide to you. Basically, when you do all the sales and costs, basically you end up with a thing which is profit and loss statement. And basically what it does, it just shows your revenue, how much you paid for how much was the direct costs, how much you were left with gross profit, and what were your these fixed or indirect costs. And that is really as simple as it gets. So for a small company, it would be like very, very simple. You would probably have just one line revenue from customers, whatever that is, whether that's subscription service or whether you, I don't know, sell some B2B SaaS and then you have an invoice every month, whatever. On the cost lines, also very simple, probably some very basic services you are using, some small salaries, maybe a small office rent, and that's it. So that's quite simple. Islabi?
We need a short break.
Okay.
Bet nevar vienkārši to mikrofonu iestrāst tajā.
Yeah, I will do it like that.
Tur varbūt var izslēgt, lai man tad nedublējas.
Bet tagad vajadzētu visam būt fani.
Vajag paši dzirdēt. Vai cilvēki dzird? Nē, labi, sārā. Tad ir, lai iestos lādētāji, ir jāizrāva mikrofonu, tas te. Ja mikrofonam neskapēc ir uztaisīts.
It should work right now.
Okay, good. Let's continue. Yes, so that's straightforward, and I mean, there's not much really to go into detail about. In the very beginning, it's as simple as it gets, and what you are paying attention to is really the bottom line. And probably it would be negative here. And everyone here, okay, I don't know. And you guys in the-
With them, so
Ah,
what was better? Before was better.
well,
It's like echo now.
so echo, so maybe too much for somebody.
I closed, but.
Yeah.
Is there someone else? with microphone?
Check it out. If I switched the mics actually.
Okay, how is it now? We don't know. Let's ask them. Yes. Good now. Okay, problem solved. Excellent. Yes, so pretty much, yeah, basically pretty much just watch this line and then look at these other line items and see like what's contributing to this. My guess is like in the beginning, you are probably not making enough of revenue, obviously, but once you start making any revenue, then we really like go into these details, go into really into detail of each number, like try to figure out like where, in which parts I make more money, less money, where does it cost more, cost less, and so on. So this is the ongoing iterative process, what you should work on. So next. Yes. Yes, some accounting things, basically balance sheet. It's one of the financial things companies track. I'll be honest with you, it's like for startups, it's not very important. I would just explain to you what it is so you know, but basically, it's basically a snapshot what the company has at a certain point in time. It does not happen what happened from months to months. It's just on a certain date. Therefore, it has some use, but not in the early days. And yeah, and it has some specific uses, but in general, like for you, very little. So basically, the balance sheet looks like this. Basically, equity and liabilities, which is very simple, where the money came from, how the company is financed. One part is equity. That's when you go to uzņēmumu reģistrs, you write statūtu šitas te pamatkapitāls, you write, the pamatkapitāls is, I don't know, 100 euros. That's your money which you have to pay in the company's bank account, and then you go back to uzņēmuma registers and they register, okay, your statutory capital is 100 euros. That's your own money which you invested. Then you can have loans. Loans could be from friends, from banks, from yourself. You can lend money to your company if you wish. And then you could have like trade payables. What is trade payables? So basically, then we have to go a bit back to profit and loss statement. So basically what happens is you sell something from 100 euros and you buy something from 80 euros. I don't know, you buy goods or services or whatever. If you are doing simple business, you would pretty immediately receive these 100 euros from your customers. For example, you have a subscription-based pricing model where you ask your credit cards clients for credit card details, and they just enter credit card details when they want to subscribe to your service, and on certain date on each month a certain amount of money is subtracted from your credit card, and that's it. So when you sell the service, you immediately receive the money. Also, for some costs, if you are running Google ads, that would be also tied to your credit card, and pretty much you spend as you go. It gets like all, I think you charge some limit to your Google Ads account, and once you spend it, it also again charges from your credit card, and that happens all the time. So these are more on, so what you have in the profit loss statement, your revenue and costs would be equal cash flow. Cash flow. So basically, when you have revenue, you have immediately cash in. When you have costs, you have immediately cash out. That's that. But the thing is, it's not always like that, because sometimes you sell products to your to companies, and companies not always pay with credit cards. They say, please send us an invoice, and the invoice would often have some payment terms, whatever you agree with the company. I don't know, 7 days, 15 days, 30 days. So basically what happens if you have payment terms 30 days, at the end of the month, you sold service to company, but the company, your client, did not pay yet. So what happens, you put that 100 euros here and you say, that's a trade receivable. I provided service to my customer. The customer did not pay yet, so he owes me 100 euros. Then for some services, I don't know, salaries, employees get paid the next month after they have, if you have ever received a salary, you know that on 5th date or whatever date after the month ends, you typically receive your salary for previous months. So that goes here, trade payables. Basically, you received service, that is, for example, salary for a person, but you did not pay it. So on the month's end, you would have those 80, 100 would sit here, and 80 would sit here, or any other. If you receive any service for which you do not pay immediately, it goes here. And that's it. So yeah, so that's where the money comes from, and this is what the company owns. So you could own like fixed assets. If you buy some machinery, if you buy computers, if you buy phones, they go here. If you provide service which is not immediately paid for, that goes here. So basically, what will you receive from clients? And finally, cash. If you, I don't know, you paid those 100 euros share capital when you registered your company, on the first day you have not spent it yet, it would be 100 euros equity here and 100 euros cash there. And that's it. That's pretty much how it operates. And that's like, it's just this is just a fixation of situation at the end of months. You basically, accountant checks, okay, how much cash you have at the end of months, how much unpaid invoices you have, if you have any assets, that goes here, and how much, like, where did the money come from, and that goes here, and that's it. So as a startup, I don't know. You can take a look at it, but like, what decisions can you make based on that? I'm not sure. I would say not too much. Yes.
If the services which are your product is dependent, if you have to pay in advance, but your customers pay you later, that is a big problem.
That's a huge problem. Yes, I will talk about later. I think I have a slide on that, but I'm not sure. But yeah, let's talk about now. That's a good point, and that is a huge problem for any company for which this payment cycle is not equal. Like in ideal situation, what you would like to have, like you would like to have, like you either receive your revenue in 1 month and have all the costs in the same month. So that's the perfect situation. Money comes in, money goes out. No extra cash needed unless you're making losses, and then you have a problem like you need some accumulated cash, how to cover those losses. But for normal business operation, this is good thing. Another thing, for example, also, if you sell to business customers with invoicing everything, not a problem. If you sell your service here, receive actual cash 1 month later, but also if you can pay your costs 1 month later, also not a problem, because you sold something here, you bought something here, but cash in here and cash out here, not a problem. Got it so far? All clear?
Perfect.
Everyone is sort of share my coffee. But yes, the problem starts when this is not equal. And this is very problematic for companies which either sell physical goods or produce physical goods, because then this cycle extends and there is a hole in the middle which you have cover yourself. So what happens? You start producing or buying goods here in 1 month. They maybe sit in your warehouse for a while. Warehouse, maybe your room, okay? But still, let's say warehouse. That's month 2. Then on 3rd month, they are sold, and invoice terms 30 days. And on month 4, they are actually paid for. So what you have to do, but you have an ongoing business. So you have costs 80 here, 80 here, 80 here, and 100 revenue. You start generating only here. Ta-da! 240. You need to have from your own pocket money to invest. And that is a huge problem. And that is actually, in financial terms, that's called working capital. That's actual money needed just to run the operations. And for trading and producing companies, this is a huge problem, because for starting up, it's already problem. But if you want to grow, you have to have, if you want to increase from 80 to 100 here, if you want to grow your business, you need to have that money up front. Otherwise, you cannot grow. And that is like a real issue for many companies, even big companies, that they physically cannot grow because they don't have this money here. And real life case, I have a client at the moment, very big company, actually, not a startup or no, already. They are not a startup already for many years. They have annual revenue of 60 million euros, Latvian company, and they are in trading business, and they want to grow. They basically they have a demand, they have like client orders, but they physically cannot increase the sales because they don't have money for this, and the problem is very real. And they buy goods from factories here in Europe. Then they organize the whole logistics chain. So they send trucks to factories in Europe. Then those factories drive to ports. Then the goods are loaded onto ships. For 2 months, those goods are traveling on ships to Africa, Asia. Then then they are unloaded. That takes also some time. Then 2 weeks they spend in custom clearance somewhere in Nigeria or Kenya or whatever. Then they are transported to their warehouse. Then they have to wait until the client comes to pick up the goods. And then they issue the client invoice, which is to be paid in 30 days. And imagine if you are running business which is like in tune of 60 million euros per year, and you want to grow, like how many millions you need in working capital to finance this growth. So at least yeah, so that's a real problem for companies. Again, this working capital issue, the case I mentioned earlier, like if you have this subscription model and then then you incur the customer acquisition costs up front, then it's a huge problem. You also need to somehow finance that, and that is something which stops companies from growing. So that's about yeah. So this is basically explanation of cash flow, and yeah, the issue with the working capital. So basically, your revenue, your profit and loss, basically. I don't know. Can you go back maybe? One more. Here, yes. One from forward. Sorry, one forward. Yeah, so basically this is when you issue the invoices and when you receive invoices. So this is not the cash flow. The cash flow is the other component where the money actually comes in and goes out. Again, like if you have like in the very beginning, it would be more or less probably equal. Either you have only cash going out when you pay for something, or later maybe it starts going in. But it's quite simplistic. So
like mobility, cargo, Andamanda, they all have, you pay to their services, and you have limited amount that you can pay, so maybe simplifies the accounting as well. 10 euros, 20 euros. So should you strive towards the digital wallet if it makes sense for you?
No, in most cases it would not, I guess. I see like very limited application, like for most businesses. I don't know. If you are Netflix, do you have digital wallet? I don't know.
It's like the same like annual subscription, so you pay advance for all the year.
But it's yes. But it's in reality, I think about these digital wallets, it's not so easy, because at least in Latvia, I think if you want to hold your client's money, you need to apply at Latvijas Banka for a license of electronic payments institution. You cannot just simply create a wallet and hold. It's illegal. You
pay 10 euros. That's it.
So you mean, for example, mobility, they have a license?
No, yeah, probably. Otherwise, they cannot do it, and that is expensive and long and blah blah blah. And yeah, it's just not everyone can do it.
So it can, here we go into accountancy here, but it can be just like called like avance masa.
I'd say you can make it like your special points, and then you have sold something and they can use them later. I think it depends how you want to call it.
No, you have to really check the legislation. I think it's quite clear set out like what you can do and what you cannot do. And I think in this legislation about electronic money institutions, like I think there's clear criteria. If you do this, and this, then you have to apply for a license, and that's it. Yes.
Account for interest rate and discount factors when computing cash flows for future time periods.
With what purpose?
previously mentioned to quantify what would be the appropriate discount if someone pays more? Or to see like how much value do you lose by postponed payments? So is it used in practice or?
No, no, you have to do some you have to do some business logic. You have to make some calculation, like how much what's the discount which makes sense for you to give to your client. Like you have to know you have to know your gross margins. Also, you have to make sure that the discount would not make you loss making, for example, etc., etc. Also, there are other soft factors like how desperate you are. If you need money now, you probably can give higher discount and get more money in.
Again, how big a discount would be actually interested to customers?
Of course,
So
yeah,
if you
they're
give a 1% discount
Sure,
for
sure.
annual payment.
sure, of course, yes.
Like card or 15%
Yeah,
5 is too low,
yeah, exactly.
15 seems like it's
So even if you compute cash flows in 1 year from now, you measure in today's prices without correcting for
Yeah, let's not overcomplicate, because I mean, realistically, the fluctuations from what you budget would be so huge that some adjustments to pricing, or again, if you are a very stable company with a very known I don't know, sales volumes, pricing, etc., etc., you can play around with those factors, because that would make sense for you, and you can like calculate like actual things. But I would say the unpredictability in the whole business model is so huge that the effort you put into making a price corrections, or I don't know, discount rates, like what benefit does it bring? There's I think maybe Martin's correct, he's like finance guy as well.
So that you put in your cash flow.
You just put in the budget if you have a bank loan or whatever loan, and if you have monthly interest payment, you just put in, yeah, that's a like for the personal loan, you know that every month from your salary you have to pay this and this for the loan, and that's it. Yeah, okay. Yes, so that is that. Also, so basically we are pretty much, I think, rounding up. Tomorrow we would be building an actual budget for each team would be building actual budget. I will provide you a template, and that would be sort of interactive process. You can ask me questions like what to put here, there, anywhere, and then hopefully come up with some sort of estimation like how much money we need, when do we break even, how does that happen, etc., etc. Yes, what else? Last thing, that's I think for tomorrow, but the Jewish law. I worked in a company, and we were attracting, we were in quite a bad situation, and we were trying to launch a project, and we had some Jewish investors, and basically we created a business case, the budget for them, and basically they came, they took a look at, and what they did, they decreased all revenues by 10% and increased all costs by 10%. And basically they said, that's your realistic view. So I think that's actually a good, quite good approach, because when we do budgets, we tend to be more optimistic sometimes, because otherwise we wouldn't be building startup if we are not optimists. But as a sort of as a reality check, it's a helpful tool. Yes, and questions, comments, anything else? What can I tell you more about finances, business, whatever? I don't know. No, I think I have given you pretty much like a lot of information already. Like think about your business model, business case, like what's your pricing model, like what will you be selling approximately? I will sell this and this item for this and this amount of money. So tomorrow when you have like the actual Excel file, you can plug in already the numbers, and like what's your sales channels, how will you reach those clients, what what should the process be like? How do you onboard them, etc., etc.? Are there any costs related to that? What are the timing for things? Because as I said, if you have not figured like the business case out, like there's no point of putting the Excel together because you cannot really, you have no idea what to put there.
Models, there's also the free model, the free in quotation marks, but Google, Facebook, WhatsApp, all these big successful companies started out as free products, and some of them are still kind of free to the user. Obviously, they pay in other ways.
No, but they are users and clients, and that's not the same thing. Yes.
In general, the whole thing about acquiring users for free, even for a product that's maybe customers wouldn't be, users would not be ever be customers. Anything to mention there? Is it still a viable thing, or is it a thing of the past?
Sure, that's a good thing. Like if you can make money, like I say, whatever makes money, like if it comes from advertising, so what? Like what's wrong with the advertising revenue? No problem. Basically, I mean, if you can build a place where so many people come and find real value, you don't have to charge them for the value. You can instead like get your revenue from advertising. No problem. Especially like what is I think what is good nowadays, like you can build niche, like sort of you can build niche communities. Let's say gamers. You build a community for gamers, and then you have like a real leverage for advertisers. You can say, look, I have a big community of gamers, and whoever tries to sell anything related to gamers, like that's a perfect place. And you can like charge really high premiums for providing your audience, because like that's a perfect spot for them. That's not like Google ads where it's just like shotgun approach. You just shoot and then see what sticks, where you just cover a whole broad audience, but like it's so much like it's non-relevant that it's just noise. So yeah, there is value in that. Yes.
Sell data.
Yes.
We had this link in Discord where there's 62 ways how to make. You can forward that to the link.
What anyone is willing to pay for, that's your possible revenue. Yeah.
Are there any distinctions, practical differences worth emphasizing between venture capital funds and angel investors, or they are quite similar?
No, I think the only distinction which comes to my mind that angels are like super early. That's like the seed money. Because I think angels don't finance the later rounds. Am I right? Yeah. Yes, that's also true. Yeah, typically. Mm-hmm.
The reason I asked is that during the hackathon we had advices to some of the ideas that those that are very nice wrapped can be better presented to venture capital funds, and angel investors are interested to invest also in commodities if they generate a more passive and stable cash flow. So it was also more of, it sounded like there is a distinction whom you approach depending on what is your idea. Is it true, or?
No, honestly, I don't have that much experience with angels, really. For venture capital funds, I think that's quite clear, because each of them, they have like certain specialization of industries or business models or so. So for example, if you do this, you can go to these VC funds. If you're in biotech, you go to those, but don't go to these. There's like some specialization. About angels, I think that's pretty much all over the place. I think that's more like if a certain individual just likes your idea or has some experience in that field and like he sees value and then has a motivation to invest maybe. Mm.
Yeah, comments about that. So our sphere, we're very specific and we're dealing with that. And VC funds don't like it, they don't go it, and they go in later. Angel investors are, as you said, just broader. Those are just individual people, either they like the idea or not, so they're way more lenient to the ideas. And they go in fast. That's what we were told by our
Just another question about the risk appetite, because usually in the investment funds, there are investors who pull their money together, so they create a huge fund, which is then invested in various different companies, so the risk diversification is higher. But for one individual who's like an angel investor, he has a limited amount of funds, so he has less diversified investment portfolio. So naturally, he has a bigger risk of losing. So that's why he'll be charging higher price for his money. Which means he'll take just for the same amount of money, he might want to claim a bigger share of your company.
But if you have this specific niche where VC funds don't even look at you, you're stuck here.
Then you're stuck, yeah, pretty much.
But also he'll be more invested in you.
Maybe you have some more stories about big fuck ups in VC funding or big lucky stories. I don't know.
Well, it depends.
About about fuck ups or lucky stories. On top of my mind, really, no. I think I already told you pretty much what I know. Yes, but I think it's in general, it's like as I said already, it's good to go to someone who more or less understands your business and industry. It would save you, I think, much time and really because the person already knows the risks which are there and they are aware of these risks. They know that they can be managed and they are sort of more willing to go forward with that.
You mentioned about 10% that the best math is in the first round do not sell more than 10%.
No, it's typically because if you go to these incubators, like, I don't know, Startup Wise guys, or you go to US to these accelerators, 500 something, yeah. Typically it's 10%, and then the amount you get is like, I don't know, in Latvia for these funds it's 250, and in US it's 500K or something. You know? The standard thing. Sorry, but what was your question?
No, but I mean, so what is the classical sequence of these rounds? Like you already mentioned, 200K for 10%.
Mm-hmm.
So what I believe, I don't know, is there any average route of this seed round, etc., or everything is so diversified, so it depends only on your company?
I think the time cycle is around 18 to 24 months, approximately, between the rounds. Then you have to hit the certain metrics, but about valuations, Martin already asked me that, but I really don't know. I think it makes best sense to like ask actual founders who have raised money and get an insight about valuations in each stage.
It's not that you reach a certain stage and then you move from pre-seed to seed after qualitatively going to another stage, but it's based on increase in valuation.
No, in real life, probably you raise money from a group of investors. For the next round, basically, for both parties, it makes sense. Like for you as a company, it makes sense to hit those targets, and for them, then come to you and give you additional money because the agreement is you hit the targets, you get more money, and obviously for you to again run this huge fundraising process, finding new investments, that's painful and time consuming. You would rather go to the same investors. Hopefully you have like hit the targets. They give you more money and on you go. And actually the same for the fund as well, because they have landed you once. You are sort of their client, not client per se, but still like they would love to see you be successful, hit the targets, so they can give more money to you and increase their portfolio.
So this movement from pre-seed to seed, which we hear a lot in this building, is based on these mutually agreed targets and not on something identical.
No, honestly, I don't know if there's like very clear-cut criteria, like if this happens, then this, and if this happens, that. I don't know. Maybe Martin knows. I don't know. Yeah.
Because you might start growing very fast and you need money much quicker than you expected. Or another story is, for example, the fund has this ticket size only limited to certain amount. Let's say they can invest only like 500K, but you'll need 1 million. So which means they can only partially finance you, and then they need to attract some co-investor anyway.
Mm. Yes, but I think your best proxy is then to talk to like actual companies who have received investments and find out how it went for them and what it actually means, the whole process, the valuations and everything, if you're serious about that. What else? Very few questions today. Very few. Okay.
You were a bit early, maybe. One of us.
Sure, sure. I know. Yes, yes. I was on the lunch with Janis, and I was telling him exactly the same thing. It's like I'm teaching you how to ride a bicycle, but unless you have stepped on the bicycle, you have no idea what I'm really talking about. That's very abstract to you. Once you get there and experience all these problems and situations in real life with your own hands, only then it would start to click like what I really mean by that. It's yes, yes, but tomorrow is the practical part, like where you participate as well and build those budgets together, and that's something for you, like yes.
Financial operations that require actual registration of a firm in Latvia. So how the finance part is really the legal part.
Finances in what? Like, what do you mean?
Like, say, further or anything, like something that a private person could do, or are there cases when you have limitations, and then in order to perform financial transactions, you actually need to be a registered.
No, pretty much. If the company, like if you'd go to depot or whatever, like you can buy whatever ingredients as a private person, and most companies sell to private persons as well. Maybe they are just like maybe there are some huge companies like wholesale companies, and they don't service like private individuals like Severstal a lot. If you want to buy like a truckload of metal parts, they would probably not sell to you. But most things I think for production as well, like you can, like there are so many online shops where you can buy like electronic parts, and from China you can buy electronic parts if you're thinking that. So I think you don't really need a legal entity to buy components.
Well, of course, at the beginning it doesn't make sense, but later on, like you can cut the 20% tax if you have company.
No VAT, yeah, that's a thing only, yeah.
But that's of course not for like for the beginning.
If you have only expenses, don't bother like establishing company. But it's crucial when you start getting revenues, because then the taxman comes.
Yeah, so basically, budget would work the same in both situations, just as a private person, you get 20% less revenue.
Yeah. Not exactly revenue, maybe, but
You know, basically about VAT, if you are a company, everything you sell, like if you sell something for 100% for 100 euros, VAT, value added tax, 21%. 21% is put on top of that. Again, for everything what you buy, 21% is put on top. And basically, at the end of each month, what your accountant does, he says, okay, like you sold services for this and this amount, VAT you received was 21, let's say, and if you bought something for 18, so your VAT payable to state is 3 euros. So basically, if you work as a private individual, you buy for full amount. So let's say on the 80% you spend 80 euros you spend for raw materials or components. Out of 21% you would not have to pay. Your cost would be reduced by 21%. If you are private individual, you pay the full amount, including VAT.
One question is we need some consultancy on this question about VAT, because now there is a law, if you are buying services from abroad, you have to become a VAT
Registered, yes.
registered.
Mhm.
So even for us, for example, if we are experimenting with our MVP and buying Google services, APIs, etc., according to current law, we have to make a company who is VAT.
Yeah.
private person.
You can buy in the beginning, I think if the costs are not huge, it makes more sense actually to just buy everything as a private person, build your MVP, and then if you see you can launch, then create a legal entity and register for VAT and do everything.
Well, of course, our government institution, they are very.
No, but if you are a private individual, you can buy whatever you want, and there's no problem with that.
Yeah, that's what constantly.
No, but again, the question is, at what moment from our government institution will become not private person?
When you start generating revenues,
Okay.
When you buy something,
they don't care.
when you sell something,
You pay VAT, so they receive it in the back.
So at first customer, you have to register company with
Pretty
VAT.
much, yeah, as long as when you want to, before you want to issue an invoice, you have to have a legal entity.
Maybe you have a critique or thoughts about our specific business model. So me and my team, we're building a product that's that deals with all your test preferences. For example, you go to this portal and then you type in the type of services you want, what happens to your pension fund, what happens to your plans, whatever. So what we thought is it doesn't make sense to be a yearly or monthly subscription. The most sense for us, it seemed to be a one-time payment, so like a lifetime. What are your thoughts about it? because it's a thing you will do once maybe in your life,
Mhm.
maybe you will object to. But like the period of that happening, let's say it's a very long, so
Unpredictable.
unpredictable. Yeah, it's not something you will do often, so it's
Mhm.
pretty much a once in your life. So
I would look at client perspective, like in what scenario do I come to decision that that's the service I want, like that's something I want to pay for, like what are the circumstances?
you just
Such a hassle.
Mm.
I want to make my children go through that process.
Mm-hmm.
it's like insurance.
Okay, and what's included in this service, what it does actually?
So you have several guides that you go through,
Mm.
and we cannot do the legal stuff. So we can only, as at this point in time, we're just adversaries. So we advise what you should do, and you can go through a list. So it's just a guide for now.
Mm-hmm.
But there's a lot of info that we've compiled that people actually don't know about.
Mm-hmm.
There is value in that.
Mm-hmm.
We don't see it being very expensive.
Mm-hmm.
I think 15 euros or something, which is again not a lot, and we burn through all of the population of Latvia maybe,
Mm-hmm.
and we don't have repeating customers.
Mm-hmm.
Hard financial model.
Mm-hmm. And basically, yeah, if you are not doing like any actual things, you are just providing information, like you are not doing anything like on behalf of client, right?
Or at this point, we cannot.
Mm-hmm.
There's several ticks that you can do in label,
Mm-hmm.
where you donate your organs or
Mm-hmm.
donate your pension and all the legal stuff.
Mm-hmm.
We cannot really do it as a service at this point in time. Maybe in the future we need to talk with all the ministries
Mm-hmm.
for it to be accessible, for you to be able to do these things in the person's name.
Yeah. No, I don't know. It's a bit tough sale, I think. First of all, death is a bit sensitive topic, yeah, and normally people maybe don't want to think about that, but maybe I see for you like how you could generate money actually is maybe cooperation with insurance companies. And basically, because like there is now a law in Latvia that you could inherit your pension, and like if you have these second or third level pensions, basically you could like do some cooperation with a Swedbank pension fund or whatever, and sort of this could be for them a channel how to get clients, and you could get money for that. You could maybe not take money from clients because the value maybe is not that big. You just provide a guide, right? But maybe provide that for free, so that would be much easier for you to market. Just what you mentioned actually. Yeah, the users use it for free. They get the value, but your client is someone else, and your client could be insurance companies because they can get the real value. They could get actual clients from you.
Maybe affiliate thing where we could act as a search for these services. People need that, but we have that in our mind for later.
Mm.
It's MBV page we are thinking.
Mm. Mm.
Organ market.
Okay.
Black market.
Okay.
Prioritization.
Yes.
I mean, target countries.
But clients or customers do not perceive well, then pricing is increased. So in order to make the initial price consciously and wisely and in an optimal way, what are the pricing strategies, or how do you know what would be the maximum profit margin that you can put on top after you computed the cost. So let's assume we sorted out the cost. What do we do next? How do we pricing?
No, I would say that it's probably a good idea to gauge the market as well. Like most probably your service is not like super unique. Try to understand the pricing level for similar products. That would give you a proxy what like range, what clients are willing to pay for similar services. That's one idea. In this book, you have all heard about the MOM test. They have a very good guide how to check out like the pricing, the actual pricing range, how you can test what are the clients willing to pay for. And also take like also depends very much of your product. Again, there's not like a specific answer. For example, like one of my clients, basically their product their product is like I don't know, ready-made IT solution for specific business segments. So what they are doing, basically, they are trying to replace IT departments of certain companies. So they base their pricing on the cost of IT department of certain business. For example, like they know that their client group, they on average have IT department of, I don't know, 3 to 4 developers, which cost with taxes, I don't know, 20 to 25K per month. So they price their product way below that. So it makes sense for the companies to switch to their product. So different approaches, really.
We tried to also get the willingness to pay valuation and just an answer of how much do the current clients pay, but the change is so significant that you do not, it's not like an identical substitute, but you make a bigger change inside the company, and then they not only they do not know exactly, but even what they know, they are not willing to share. So you ask 4 times and you cannot get any quantitative answer on what are they actually paying now. And then you have to price in blind and try to hit a better price of what they currently pay. And that's very hard. So you thought maybe there are some.
No, I don't know. No, it's again trial and error. If you're like if you're doing with it sounds like you are your customers are businesses, governments. No, I mean of course they are most often like when someone buys something, they are bound by NDA. They cannot disclose the pricing to anyone. Blah blah blah. What you can do is what I would do. I would probably go to I don't know. Customers, I would maybe start with those customers which I think maybe are I think there's no chance for me to land them, so I cannot lose the sale, and I would sort of gauge the price like would you buy like this is my price, like is it too high or too low for you, like is it more than you are paying currently or less, somehow indirectly. Of course they would never tell you what is your price, what they're paying currently, but you can ask like what should be my price in order for you to switch.
That's exactly how we ask.
And they don't answer. Okay, I don't know.
Well, the best we could get is approximation like in units. Compute us the price.
Yes.
For a year for 5,000 units.
Yes.
And then we can say whether the price is.
No, I don't know. Again, you be creative. For example, when I work for a company and we launched a business in abroad, and we didn't know like what the prices were for certain services. And what we did, we basically we took out the guys who work for this place. We took them out for nice dinners and lunches and whatnot. And in the end of the day, we knew exactly how much each of our competitors pays for each product. We had like a full information. Old school, pretty much, but that's how you do it. Mm. No, but really, I mean, build relationship, take them out to nice dinners, and just suck out information. Yeah. Mm. Especially if you want to work with governments or like big companies, probably you know that, but the sales cycle is very, very long. I don't know, 6 to 12 months, and that's because there's a lot of relationship building. You have to court your customers for a long time, meet them now and then, take them out for lunch or dinner, whatever, and so on. Yeah.
Understand real decision makers.
Yes, that as well. What else? Okay. Thank you very much for your patience. Thank you for patience, for listening. See you tomorrow.